So just a few days ago, Robinhood released option stops on their platform. So we're going to go over what those are, how you can use them, why maybe you shouldn't use them, and then also we'll do a live trade where I trade options and get stopped out using a stop loss. So you guys can see what it actually looks like IRL. So if you are familiar with setting stop losses for trading shares, this should be fairly easy to wrap your head around, although there are definitely a few differences. But when you're trading shares, so let's say this is the stock price on the y-axis, maybe you see this higher low and you're a smart guy, so you buy into it really fast. But you're even smarter than that, and you set a stop loss so that your risk is limited. So maybe it goes up, you don't take profit because you're an idiot, and it goes back down, takes a pooper, hits that stop price, and you get stopped out of the trade. This is exactly, well, almost exactly how option stops work, except for instead of this being stock price, it's going to be the options price. So you're setting the stop loss based on the options price, not what you're seeing on the stock chart. So let's do an actual example because there are a few differences. It's not exactly that simple. Let's say we're looking at some calls and they're looking ripe, delicious, juicy. There's condensation on the outside of them. They just look so supple and sweet. And so you're looking at them, about to buy them. As you're looking at them, you see the bid-ask spread is $1 to $1.20, where this is the bid and this is the ask. And from the retail trader's perspective, the ask is the price you have to pay to enter the trade immediately. That's why it's green. That's why I made it green there. You can set a limit order for something a little cheaper between the bid and the ask spread, and hopefully the seller will meet you in the middle somewhere. But regardless of who pays how much or who gives up how much, the difference between the bid and the ask is paid to the exchange as compensation for marrying these two buyers and sellers together. So let's say you think it's about to blast off to the moon. So you want to buy into this really quickly. So you pay the $120 to, whoops, let's get rid of that. $120 to enter the trade. And this is your entry price. And it's not $1.20 because up here we're looking at options premium. With options, they have control of 100 shares. And this is the options premium per share. So you basically just multiply this by 100 to get your actual price that you'd pay to enter the trade. And this is the max you can lose. Can't lose any more than you paid for it when you're buying calls and puts. So that's nice. But let's say you bought this and you were actually out of bed for the day. You were fully clothed. You had your glasses on. You were thinking like a big boy. So you want to set a stop loss to limit your risk. Well, there's two prices you're going to set the stop loss. Which is a little weird. That's the one thing that's different than over here. I just pointed at my screen. I have to use this. One thing that's different over here is that you have to set two different prices to set a stop limit order for option stops. The first one you probably wouldn't set, but we're going to start with anyway because it more realistically shows how much you're risking, is the stop limit. So you're going to have a stop limit order, which is essentially the price that you want to get out of at the end of things. So let's say I only want to risk $40. So I would set a stop limit of 80 cents. Remember, this is in options premiums terms. So 80 cents times 100 is $80. So you're risking only 40 between your entry price and your stop limit. So in premium terms, this is $1.20. Now, the second price you want to set is the stop price. So what's the difference between the stop price and the stop limit then? The stop price is the trigger for the stop limit. It is the options price where the stop limit gets sent off and possibly filled. The reason you want to have a stop price and a stop limit is because options prices can move very fast, especially when they have large bid-ask spread like this. The mark price, which is the price that is shown on Robinhood and is the middle of the bid-ask, can jump around pretty quickly. So if it were trading down to 90 cents, it could 85 cents, it could potentially jump down to 75 cents and jump right over your stop limit. Remember, this limit order is saying I want to sell for 80 cents or better, and if the price is below 80 cents, you're not going to get filled. So it can skip your stop limit altogether. So you want to have a stop price that's a little bit higher. So for this kind of wide bid-ask spread, since it can jump around pretty quickly, I might set, hypothetically, not saying it's the best idea ever, but I might set a stop price for 90 cents. This way, if the mark goes down to 90 cents, the stop limit gets triggered. And even if this is jumping around a little bit or moving pretty quickly, odds are this will get filled since it's trading at 90 cents and your stop limit is at 80 cents. It'll probably get filled immediately once this gets triggered. So all this is a little cushion to prevent the options price from skipping right over your stop limit. This is supposed to protect you from that, but it can still skip right past everything. If it goes down to 96, triggers your stop limit order, but is still moving very quickly and no one meets you on the other side to buy it from you, it can trade right past your stop limit and right past, or stop price and right past your stop limit, and can keep going down, which should be pretty bad news if you're not paying attention. So it is possible to skip both of these and just keep on going down. So just be aware of that. Keep eyes on your trades. This is not a foolproof way to limit your risk. So before we get into my opinion on this and an actual trade that I did, the summary of all this is simply, it's the exact same as setting a stop loss for shares. You're just setting a price you want to sell at. The only difference is you're setting a trigger price and the actual price you want to sell at. And the trigger price protects you from it skipping right over your stop limit. And the wider the bid-ask spread, it's probably advisable the wider the difference between the stop price and the stop limit, just to keep it from gapping below your stop limit very quickly. Okay, Adam, so this seems pretty cool. Why do you sound like a little salty boy? Well, let's get into that really quick. So let's go over the good and the bad from my perspective, my personal opinion on option stops. And I suggest you hear me out on this one. So the good thing is you have a plan. You should always have a plan when trading. Setting a stop limit for options shows that you have a plan. You're not just going to sell based on some gut feeling. If all of a sudden your stomach gets sour and you're like, okay, this doesn't feel good, I'm going to get out of here. You actually have a plan. That's a good thing. And that's about the only good thing because, well, let me explain why. The first reason I don't like these is because it can gap past your stop, both the stop price and the stop limit order, and keep going. So essentially rendering the stop loss useless. The second reason I'm kind of poopy about them is because the options price stop losses are based on the options price. We're going to abbreviate here. So normally when you're setting stop losses for like trading shares, you're looking at the chart and you might see levels of resistance and support. So you might set a stop loss below this level of support because it's less likely to go below that. You have an actual plan and reason why you're setting your stop loss there based on technical analysis and your position sizing. But when you're basing it on options prices, it's a lot more difficult to do that. You can kind of guesstimate and sometimes use different calculators to see what the options price will be based on the stock price. But since implied volatility and theta have changing effects on that option, it could not be accurate. And basically it just boils down to, I'm using this option stop loss because I just want to risk maybe $30 today. That's just how I'm feeling. It's 3% of my portfolio, whatever. There's no real thorough plan to it and a reason behind the stop loss. So that's my second complaint, is that it's either impossible or very difficult to base the stop loss on technical analysis. My third reason I'm a poopy boy is because this stuff has been around since the 1980s. The 80s! I think, and Robinhood's kind of flaunting around like it's groundbreaking stuff, but really I think the reason they've put this out is because of the recent wave of competition among brokerages. They felt like they need to find something to give to people to show that they're actually working on their platform. So it's a good thing they added it. Probably should have had it to begin with. That's my personal opinion, but you know, it's Robinhood. They're just taking their little baby steps. But they really got to step up their game as everyone drops down to zero commissions, man. Yikes. Okay, let's get to the trade where I actually demonstrate how to use this in real life. Here we're looking at the S&P 500 ETF on Thinkorswim by TD Ameritrade, and this was recorded in the past, so you'll see another mouse fly around here too. What we see here is a descending triangle where there's this level of horizontal support and this descending level of resistance. Typically, this is a bearish pattern where it will break below this level of support and you sell into that. But it can also break above that as well, and you can see that starting to happen as the pressure it gets to this pressure point right here. It is pushing up above that level of resistance on good volume, and you'll see me checking the time. I'm just waiting for it to close above the VWAP to confirm this bullish trend. So I have a call primed up and ready to go, and you can see the bid ask here, and you'll see I'll buy it at the ask here in just a moment. So that 5-minute candle closes, I send off that trade. Awesome. So now we're going to set a stop loss, and I think if I remember correctly for this example, I was just risking $50 is what I was trying to do for an example. So you go to the call, go to sell, up in the upper right hand corner, you click on the cog. You set a stop price. Remember, that's the trigger that you'd set, and you could set good till canceled, but this is a day trade, so I don't really need it to last more than today. So I set the stop price at 1.60, which is about $50 risk, if I remember correctly. Holy cow, I sped through this. And now we just wait and look and see what happens. On the left side, we can see the value of the call fluctuating as the share price changes as well. And this is fast forward pretty quickly. And you'll see at some points I'll adjust the stop loss, like right there, just so I don't have to sit here all day. I was mostly using it as an example to show what happens when you use the stop loss. So you see me adjust a little bit, but I'm just gonna let you watch and see how this call price changes with the stock price. And I'll slow it back down once we are about to get stopped out again. And I just want to note, you can see also confirm this bullish trend is riding above this blue line, which is a 9 exponential moving average. It is above the VWAP, and it broke above the VWAP on good volume. So you can see I'm adjusting the stop some more. Now you'll see here in just a moment a good example of how this could skip right past your stop price and your stop limit. So as it slows down right here, nope, there. I set a stop price of 216, so that's my trigger, and a limit price of 215. So once it hits 216, it should set a limit order for 215. So it hits 216, the limit should be sent out, but now the ask is at 215, so it's not getting filled. Remember, I have to sell at the bid. So it's not getting filled. It could have kept going down. Thankfully, I got a little confused there for a second. It bounced back up. My limit order went through and it sold that call. Now I know that was pretty quick, so if you need to put that, go back and put that on like half speed, I don't blame you. But thanks for watching, guys. I'll catch you in the next one.